Something we've been talking about a little bit recently. It's come up a lot in the streams, and we're talking about, knowing when to hit the gas, knowing when to throttle things back in our personal trading. And we all know that trading is a sweet science of sorts. There are things that we can understand, there are things that we can be prepared for, there are skills that we have, and the market is also chaotic and it's going to throw things at us. And it's this beautiful mixture of order and of chaos. And the market is going to give us repeatable type action that we can observe and that we can take advantage of. But that action, even if it's a repeatable type setup, it's not going to surface the same exact way every time. It's like a freaking snowflake. No two are going to be identical. And you might have, just as a simple example, some kind of a continuation pattern that you take advantage of, where if there's a catalyst or if the market moves with a certain amount of strength and we go through a specific consolidation type of pattern, you know what to do. You look to enter in on that and go for the continuation. That same setup will happen, and there'll be times where that consolidation goes on for so long, longer than you'd expect, and you might start to think that this is running out of steam and maybe this isn't going to be working out. Or potentially it's going to happen very quickly and it's not going to consolidate for long. And if you're not there and if you're not prepared and if you didn't observe it quickly, you're going to miss it. You're going to miss out on the move. Or times where before it gives you that continuation, it's going to have some kind of a false breakout. Yeah. These are the same exact trades, but they're going to be just different situations and in different ways that they surface. And it's because of this dynamic that we have to be in a position of just making those real-time game decisions. And don't ever lose sight of the fact that what we're doing here in trading, this is a performance sport. And just like any type of a performance sport, we have to be able to make these real-time game decisions. If you're a UFC fighter, you can study the tape and you can be prepared for your fight. You can have your skill. There are things that you're ready and prepared and willing to do. But in the chaos of being in that fight, there's going to be these moments where it's time to go for that takedown. It's time to throw a kick. It's time to throw a jab. And this is something that your corner, your coaches can't really tell you. This is something that you can't just observe in hindsight that, oh, yeah, that was a good thing I should have done there. You have to be able to do it if you want to compete in the UFC. And I would say you got to be able to do this if you want to make money and if you want to be a trader. So thinking about this, and let me give you just thoughts for your thoughts on this idea of knowing specifically when to throttle and when to hit the gas. Because talking about real-time game decisions, this is one of the decisions that we have to be able to make as traders. And in theory, a lot of things make sense when it comes to trading. There's a lot of things on paper that they seem perfect, but they do not translate into the real world of trading. And it makes a lot of sense on paper that every time you have a setup, just enter in with this much size, take this much of a loss, or take this much of profit. That sounds perfect. But the reality is that trades are not created equal. They don't surface equally. You might have two very similar trade ideas on different days, and the opportunity that those are going to provide you will just be absolutely and wildly different. So let's kind of break this down and I'll give you some thoughts here about things that have worked for me and things that I'm sure will help you too in trying to make this decision on when to hit the gas. And I think this topic can be broken down into two different parts. One of the parts just being your personal trading IQ. This is a little bit more hard to speak about or hard to give maybe some specific thoughts about because this just has to do with your personal experience, the screen time that you're putting in. A lot can be said about it, and it's an important skill to have. But there are also some specific strategies and some tactics that we can talk about that will help us with this understanding of when is it time to throw things back, when is it time to hit the gas, and how to be a bit more dynamic when it comes to our trades. So the first thing that I would say when we're trying to get this sorted out for our trading is just make sure that this is a part of your risk plan. You're coming in, you have a plan for your risk, you have the normal amount that you're looking to trade, but you understand that not every trade is going to be equal opportunities. And so you have that normal amount. Maybe it's 3 ES contracts. Maybe it's $200, $400 per trade, whatever it is, it doesn't matter. But you have this amount that you're risking typically on a trade. And then you also have a drop down version of that. So maybe you're trading 3 ES contracts, but you have a scaled down amount that's 6 micro contracts. And then when things are going extremely well, maybe you have just flow going on in the market, you're building a cushion on the day, you're having good setups, the market's being favorable, you want to hit the gas, maybe you have a max position size of 5 contracts. Some version of this. Recently on the podcast channel, I guess this hasn't actually been that recently, but we interviewed Al Brooks on the channel. And you can reference this back. It was a good listen. But one of the things he said that really stuck with me was this idea of just having a more of a effortless type of more of an effortless type of risk sizing that you could use. And what it meant by this is the normal amount of risk that you would be using on a trade creates a certain amount of stress and anxiety and a certain amount of tension, which it should, because we need to be pushing ourselves with our risk. But then having an amount that you can just drop down to that is a bit more effortless for you, and it's not really going to make you feel a certain way, and it's going to be easier to put on those trades because a lot of trades don't provide us with the best opportunities. But the idea that he was saying about just having this set standard of risk that you went to and that you go to. And I think that this is very important because when we're trading, there's a lot of things we have to focus on, a lot of things to pull our attention on. And any decisions that we can make ahead of time, we just want to make sure that those are made and that those are done. And what we don't want to do is be in a position where we're trading and we understand that this isn't quite this is a valid trade idea. The risk reward makes sense. This is a trade I want to be involved with, but I don't want to go into my full size. So I'm just going to make up some kind of a random drop down amount. Just have that figured out ahead of time so you know when that situation happens, this is the size you're using and you're done. The same thing when it's a trade that you feel like you need to hit the gas on more, you know how much you're going up to, and it's not some kind of an arbitrary number that you're just in the moment, making up. So just understanding that these are going to happen, be prepared, make this a part of your risk plan. A second thing that I would say to this, when we're talking about knowing when to hit the gas, of course, we have to be very clear about what are the good trade opportunities for us. And even if you're trading the same method as somebody, the trade ideas that are going to be the best for you might be slightly different. And so this might be an obvious point, but getting clear about the fact, what are my good trade opportunities? And one of the ways that we can do this is, of course, just making sure that you have mastery over your method. In trading, there are so many shiny objects and a lot of noise, a lot of different things that we could do to make money in the markets. But although we could make money a lot of different ways, we can't make money every way. And so there does come a time where we have to find a lane. We have to be able to stick with it and just get good at something and build up a certain level of mastery with the tools that we're using, with the method that we're following, with how we're analyzing the market and executing. And this, of course, will go a very long way for helping you to understand what are your good trade ideas. Because if you are a novice with your method, it's going to be very difficult to put together what are my good trade opportunities. And in the same vein, it would be very nice to have a process where you can reflect on your trades. SMB Capital popularized the idea of having a playbook. And part of that playbook is having a process of daily reflection on your trades, understanding what went well, understanding what could be improved upon. And this process of where a trade happens and then it's just gone and kind of lost to the ether forever. But if a trade happens and then there's something there where you reflect upon it and you understand what went right, what went wrong, how you felt about that, what you could have done better, this is going to help you dial in very well over time on just what exactly are you doing better? What are the trades you're the most comfortable with? What are the setups that you're seeing the most clearly? And this would be an important step to helping you understand when it's time to hit the gas and when it's not. A couple more things I'll say about this. Find out what you are naturally good at as a trader. When we're trading, there's really only two things we can do. We're either looking to fade the market's in some type of balance, and we're looking for those outside back in type trades, or the market is in some type of a trend, and we just need to be joining that action. It's very much been my observation that it's difficult to be good at both of those. And what will happen is you're probably going to feel better about one of those than the other. You might be somebody who's a bit of a contrarian, maybe a bit of a MGTOW of sorts, where you're comfortable doing those outside back in, fading the market type of action. And you might be somebody who's a little bit more of a sheeple. You just want to go with the flow. I get it. You can do this. It's okay. But whatever's easier for you, whether you want to be joining that action or not, it's important to know this because realistically, you're probably going to gravitate naturally towards one or the other. And if you can put together that, hey, I actually feel way better when the market is balancing out to look for those extreme type of ranges and look to try to bring that back, go for those outside back in trades. Well, when the market is giving you that, this is a good time for you to understand that it's going to be time to hit the gas here. And when the market starts to trend and you know that that's something you struggle with, this is going to be one of those times to start throttling back as well. And of course, vice versa. If you're good with the trends and joining that action seems easier for you, then you can just do that as well. And then when the market starts to balance out and it becomes clear that we're stuck in some type of a range, just know that these will be times we need to throttle things back a little bit more. Okay. A couple more points on this, a couple more thoughts for your thoughts, and then we'll move on. The next thing I would say is just start to put together when you're getting mixed alignment and when everything you're seeing is in full alignment. There will be different time frames that you're looking at. There's different tools that we all look at. And there's going to be times where we have valid setups that we can take and that we should be involved with, but not everything is lining up 100%. And then there are times where where there's a lot of mixed signals that we're seeing, a lot of mixed information. And in those times, we just have to be patient, let the market give us more information and wait for clarity. But then there are times where everything is showing us the same thing. I might be looking at a monthly value area, a weekly value area, a micro composite, and all of those are telling me this market is liking balance right now. Or all of those are telling me the market is liking this direction. And when we have of the different timeframes and tools that we're looking at, when we're starting to see a lot of alignment there and everything is telling us the same thing, this, of course, is a good insight that this is probably going to be a better trade opportunity for you, probably going to provide you with a better opportunity, and more likely going to be a time that you are going to want to hit the gas. And then from there, the more and more discrepancies that you have, or the less clear it is, or the more mixed information you're seeing where things aren't lining up quite right, this is going to be times where we'll typically want to throttle things back a bit more. And the last thing I'll say is when there is a start of a new piece of context, this can be a very good time for good trade opportunities. Understanding that the market only balances out or trends. The market matches together buyers and sellers. When it does this successfully and everybody's happy with price, we have balance. Then something happens. There's some kind of a catalyst, some kind of a news event. Something happens where buyers and sellers are no longer agreeing on price and we enter in some kind of a trend. The market will trend and it will trend until it finds a new spot where buyers and sellers are agreeing on price. We're going to have balance again, rinse, wash, and repeat, balance to trend, balance to trend, balance to trend. Now, with that being understood and just that basic understanding of how markets move, the longer that we do something, the closer it is going to be to ending. The longer that we trend, the closer we are going to be to starting new balance. The longer we hold balance, the closer we are going to be to breaking out and starting a trend. Now, this is very relative because balance can go on for a very long time. A trend can go much farther than we ever thought it would. It can go for a very long time. But the logic still holds that the more we do it, regardless of how much longer it's going to do it, it's still getting closer to stopping. And when we have a fresh change of context, so the market is just starting to find a new area of balance. The market is freshly moving away from an area of balance and starting to begin a trend. Where that begins, or where the balance begins, that fresh change of context will typically provide us with the best opportunities that we can have. Because again, the longer that this goes on, the sloppier it's going to be typically, or at least the closer it's going to be to ending. So in your analysis, when you can start to put together that, okay, this is I'm following trends. This is what I look to do. This is not just a trend that's continuing, that's been going on for a while, but we've been in balance and we're freshly moving away from this. This is going to be typically some of your better trade opportunities and the times when you're going to want to hit the gas. And when we're coming out of balance or coming out of some type of a trend and we're starting a new area of balance, or maybe we've tried to briefly push away from it and we're freshly returning to balance. These are going to be typically the best opportunities and at least provide us with more of what would be an A+ setup of sorts. And then one more thing as a bonus, I'll say, the last thing I'll say about this is just dealing with what is our human nature. Because typically it's very normal when things are going well and the market is being favorable to just want to throttle back. And when things are going bad and the market is just being a mess, to just want to be super aggressive. Thinking about a day where you come in, the first trade was a winner. how easy is it to just kind of stay out of the market? Or even how difficult is it to want to keep trading? And then a day where you come in and your first two trades are losses, that's a day where you want to sit there and just fire on 30 more trades and be the most aggressive person in the world. Yeah. And although this feels very natural, it's the wrong thing to do. When the market is just being favorable, like that trade review we were looking at earlier, like that was very favorable action for me. And when that is happening, it can feel much better and it feels like the right thing to do to just kind of pull back. But this is the time where we need to really step up because this is likely going to be a time where you need to be more aggressive because the market is not always going to be favorable. And when it is, we just need to make sure we're taking advantage of that. And then on the flip side, when the market is just hard for you to read, maybe you're just kind of a step behind on things, you're just not seeing it clearly, it feels like you're forcing things. This is time where it's just important to throttle back. You're not going to want to. It's probably going to be more natural for you to want to keep being aggressive and size up like crazy or do something extreme. But this is a horrible idea, and it's typically going to be the very wrong thing to do. The market gives, the market takes away. And in our trading, we just want to make sure that we are getting better at understanding what are our higher quality opportunities and how we can take the best advantage of those. Because losses happen, bad days happen, trades that don't go to target and end up just being very small winners, these things happen. And if we're in the habit of having those things happen, but also in the habit of not knowing what is our best trades, where we're going to do the best, what are providing us with the best opportunities, and if we're not taking advantage of those, it's going to be very difficult to keep the equity curve going up and to stay profitable as a trader. Listen, at some level, we're all in this together. So with that, I'll wish you very happy trading and good luck out there.